I am going to bring back up Matt and Scott. They're going to just briefly touch on the advantages of depreciation and how you can take advantage of those through our equity deals. So again, please give it up for Scott and Matt, and you guys can take it away. Thank you.
Thanks, Rich. I was tasked with speaking about depreciation, and then I realized I have one of the smartest minds and my accountant in the room, and I said, well, Matt, why don't you come join us up here, because I'm sure you could be a little bit more of an authority than I can be suggestive. As a real estate investor, as well as a syndicator, which is what we do, we syndicate all of our transactions. I get my top 3 questions I get are, or the statements are, I need losses, right? How many people have made money this year and are talking to their tax accountant probably in Q4, so that'll happen next month, and then you realize, holy smokes, I owe a bunch of money, and I'm gonna not pay that bunch of money because I'm assuming, like you don't think you get a lot for that money you give the government. And I think I get negative when I give money to the government. That's just my personal mind. But I think the idea behind it is, how do we as investors protect our ultimate tax implications, right? And if you look at the wealthy, the ultra wealthy, they pay little to no tax. Remember when our current president was in office, everyone wanted his tax returns because everyone was interested to know how little taxes he pay, right? That's the game. The game is 50% investment and 50% tax prevention or tax payment, or maybe the equilibrium is off in a different balance format. And so I get all the time, how do I get losses? When can I get those losses? And how do you help me as a syndicator or as an investor get losses? And those are all great questions, right? And there's some very basic concepts that we can understand, right? If you are not a professional real estate investor, you're considered passive by the IRS, by the government. You're a passive real estate investor, and you can achieve passive losses up to your basis, which we'll talk about in a minute. And when you get to your basis, you can then write those dollars off against passive income, right? Passive losses, passive income. You can kind of basically understand the theory behind it. And then we interject as the syndicator, say, we're gonna forward depreciate, we're gonna accelerate, and we accelerate through what we call a cost segregation or a 179D, which is a concept in our tax code which allows us to take a commercial asset, which can be depreciated over 27 or 39 and a half years, and ultimately break that building down to its most granular way. Flooring is depreciated at 5 years versus something else that's depreciated at 7 years. And we take that building and we ultimately provide a first-year tax loss that's bonused. I looked at a tax depreciation on a deal that a friend of mine's doing, and he's getting $336,000 in year one loss on a $2 million purchase. And that loss carries forward to the investors, the participants, to the basis. And so that's the theory, right? And so having Matt Hamilton with us today, I'd like to kind of pose some questions to him that I get from people, and then if you have some questions, let's talk about them. We're going to focus on that loss concept. Many of our investors, Matt, are W-2 employees, right? They've worked for somebody or something and earn W-2 income. And they take that after-tax dollars, they invest it with us. How does a cost segregation study or a bonus depreciation, how does that help them offset their taxable income?
So if you're a W-2 employee, all of your passive income is in that passive bucket, and your W-2 income is in that non-passive bucket. So it creates that challenge. And oftentimes, like many things in real estate, the initial step of kind of getting started and making that first investment doesn't yield huge results, but it kind of starts that flywheel, right? Because as you begin to make more and more passive investments, you can use those passive losses to offset that, that exponential growth of passive income you'll see. But in that first year, with the exception of becoming a real estate professional, it becomes very challenging to offset that W-2 income. Through the passive investments, it's not possible.
So understanding that nothing was built in a day, or Rome wasn't built in a day, if you take the concept, Matt, of a passive investor who is either investing in a deferred IRA or a deferred some retirement account, that has its deferment, which is taxation on the profits, taxation on the gains in that environment. If you were to take a passive investor, and at F Street, we take passive investors and we say, invest in everything at a level you're comfortable with and do it for multiple years. And we show in one of our strategies, we show an investor's invested since 2019, and they've made $1 million of investment. They have $1.7 million of value. If you were to extrapolate for an investor a 10-year horizon, right? I've been investing, let's say they make X of dollars of investment in 2 investments a year for 10 years. That taxable loss that they have, do they get to keep that until they use it? And then do they get to use it against that income that is in 10 years?
Yeah, exactly. So that's kind of what I was getting at with the last one, right? So if you invest in this first deal, ton of depreciation in year 1, you have this huge loss, and if you don't really have much passive income, then there isn't really a ton you can do with that loss. So it gets suspended and carried forward, and it can offset future income.
And does the carry forward expire ever, or is it into perpetuity a carry forward?
It's in perpetuity a carry forward, with the caveat that Congress could change that.
Sure.
But as of right now, it's that carry forward is in perpetuity.
So you would take the loss today, you could build up your losses that will ultimately build up a deferment against your gains in 3, 5, 7, or however many years that comes together.
Yeah, absolutely. From a tax perspective, one of the most powerful engines when it comes to wealth creation is understanding what income goes in that passive bucket and generating enough passive losses year over year to never have to pay tax on that passive income. Because if you can build up a big enough loss reserve, then even when these projects become profitable from a tax perspective, you never have to recognize that income because you have all these losses to offset it with.
Does that include, as I just look forward to, we outline a 4-year IRR hold or a 5-year IRR hold or a 7-year. Would that bucket of losses help on a sale where there's a massive gain so that there's no taxation on that gain as well?
Yeah. So to clarify, if one of the passive investments they've made with you, if one of those they sell that, it's all still in that passive bucket. So as long as it's all in the same bucket, those losses can still offset that gain.
And so just to give everyone kind of the idea, as syndicators, we project a 4-year hold, a 5-year hold. We project, we build stuff and we invest in stuff that takes time to create and then the ultimate value. So what ultimately happens is we give this depreciation that allows for these buckets to get created, which are losses, that ultimately, if you disciplinedly invest, whether it's in our deals or deals as a passive nature and get passive losses, in theory, in 7 years from now, let's just say 7 years from now, it seems like a long time, but you can actually lease a car for 7 years now, so maybe it's not that long. If you were to do that, you would have all of this loss that you could start earning real income, $100,000 of income a year, $150,000 a year of income a year for an individual, and have $150,000 of those losses that you pay zero tax on.
Yeah, correct. So that's 100% true. I think another thing that's actually really important in part of this conversation is understanding the economics of how the cash distributions that you're actually receiving are not necessarily tethered to the actual income piece of this. So while this whole tax conversation is happening in the backdrop, you're generating these passive losses and offsetting passive income, or you're offsetting passive income as it's allocated to you. You're still receiving these cash flow distributions, which on their face are not taxable. They're considered a return of capital. So while you're not paying tax on this passive income that's coming in year over year that you're kind of offsetting with these losses, you're still pocketing this cash. And it's not part of that income that you're offsetting.
So I think because I think I'm confused, but I'm not that confused. I think what part of what is Matt's saying is that when we start returning your capital, even if it's in a cash flowing asset today, day one, those dollars that come back to you are not taxable as income because it's a return of principal in the allocation of return of dollars. So if you invest $100,000 and we are paying you 8% preferred return and you're getting that 8% in real time, you actually are kicking the tax can down the road materially because you're not paying tax on that. You're just taking a return of the principal that you've invested, which further, which increases in significance that loss run, because you're creating the loss. And if you're not going to get those money for 36 months till all that money's paid off, you have all these losses that are really banked in that future, which makes it incredibly more powerful at the end of the day, because your income still has to count as a repayment on your $100,000 or whatever your investment dollars are. Yes, sir.
I'd like to get that profit in Bitcoin, please.
Yeah, no problem. We can get that done for you. We can get that done. Yes, sir.
At what point do you get into trust and how those protect money?
Yeah, so trusts, yeah, there's a serious education that leaves once you leave LLC and just call it partnerships and K1s and then goes into trusts. And Matt, maybe you can help answer some of those questions related to trusts and how they're taxed, and then ultimately how passive income, passive losses flow through to trusts.
Yeah, absolutely. So caveat, I wouldn't consider myself a trust expert, but I know enough to answer pretty general questions. So to your point, it really depends on the type of trust, right? So if it's an irrevocable trust, then it's its own entity, right? So that entity is paying tax. But if it's a revocable trust or a living trust, then it's what we call a disregarded entity for tax purposes, where the IRS just completely ignores it, and it's as if you're just reporting that activity on your own personal return. I don't know if that answered your question, but
More along the line of the charitable, where you don't pay tax when it goes in, or SLAT, which allows access after the fact.
gotcha. Yeah, to be honest, I don't have an answer for you, but let's connect later, and yeah.
Thanks, Trey. We're going to keep going. Are there any other questions? Okay. So a couple other questions that as we evaluate real estate deals and we hear about real estate is really the future, is it exclusively focused on that loss carry forward, or are there other benefits to families, people, individuals, as to why so much money moves into ultimately real estate investment?
So it has to do with kind of this tax deferral piece that we're kind of talking about now. It's ultimately about taking those tax benefits up front through depreciation and all these other losses, and keeping that money in your pocket now to invest and deploy now to compound those returns more quickly. But why you see so much, I'll say, generational wealth go into real estate is the idea that you can simply defer, and then die. That's the strategy we
Is that 3 deferments before you die, or is it 2?
You can get creative with it. It's as many deferments as you want, but it's
So just keep deferring and then die.
yeah, because ultimately when you pass away, there's that step up in basement for your or a step up in basis for your heirs. So if you can defer the gain for as long as possible, then
So let's talk about that, because we see a little bit of that right now. For my having been doing this for 20 years, I have my first entity that has a bunch of partners we've deferred, and in that second to third deferment, unfortunately, I've lost a few of the members, right, and their families are. What if the deferment happens and then ultimately it gets transferred to an heir? The step up in basis, how does that get calculated, and then how does that get articulated to the IRS or to the estate so that basis is increased?
that is a great question with a lot of nuance. So
Okay, give us a high level then, sorry.
So just backing up, if you own real estate, let's ignore the partnership component. Let's say you own real estate and you pass away. Very simple. There's a step up in basis of that real estate up to whatever the fair market value is. It gets complicated when it's in a partnership with multiple partners, because technically what each of the partners own is not real estate. What they own is ownership interest in an LLC that owns real estate. So what you're getting a step up in basis on is your ownership in that LLC. And how that translates to the real estate side is that LLC has the ability to make what's called a Section 754 election, where the partnership itself can step up the basis of the assets, and that partner can actually reap the benefits of additional depreciation because you're effectively stepping up the basis and then depreciating that new basis. So, like I said, a lot of nuance. That probably dove way too far into the weeds.
No, it's good.
But yeah,
That was helpful. So we do see a lot of families, and we do experience this, where a lot of people come to us with a 1031 that they have, and then they want to place those dollars with F Street. And so when that happens, we get into what they call a TIC, or a tenants in common, and then the nuance of that becomes the TIC owner owns X percentage, and then the LLC owns the other percentage. And can you walk us through a little bit about 1031s as far as transferring out, and then how that looks in whether they invested with us or on their own, and then that step up in basis for the new asset and then the new depreciation schedule?
Yeah, so 1031 exchange, it's a like-kind exchange is what it's actually called for tax purposes. So like-kind meaning like-kind property for like-kind property. So if you own real estate, you want a 1031 exchange that property into a new property. Kind of what you alluded to, you have to do it through a TIC. Why? Kind of what I was saying earlier, when you invest in these properties, you're not investing in real estate per se, you're investing in an LLC that owns real estate. So what you would be exchanging is a real asset for ownership interest in an LLC, and those are not like-kind assets, which is why you need to go the TIC route, where instead of owning an interest in the LLC, you're actually on the deed. You would own a percentage of the property outright whenever the property is acquired, which is why you would have to go that route for a 1031 exchange, which is why I brought up the lazy 1031 exchange earlier, because it kind of uncomplicates that problem. But that's how that's kind of where that problem comes from.
And to that level, there's been a lot of discussion, and there was a most recent filing in New York about what we call a drop and swap, or a LLC. So if you think about it like this, if you're an owner in that LLC that doesn't really own real estate, it owns interest in real estate, and you end up doing what is called a drop and swap, where you drop from the entity level into the ownership level as a TIC, right? So if we are all partners, if we have 10 partners, and partner 1, partner 2, partner 3 through 10 would be an owner as 1, 2, 3 LLC. If we were to drop that LLC and redeed the property to ownership 1 through 10 as a now TIC tenant in common owner, the IRS has viewed that concept a little differently up until there was a recent filing by the New York, I think, Eastern District that said that it is acceptable to do a drop and swap the day of, which means that the day you're closing, you drop out of the LLC into the 1031 TIC, into a TIC, and then you can exchange out of it. And so I'm wondering the tax benefits of that, which I think are important, and then if you could help us understand, if someone's in an LLC today, whether it's not with us but with someone else, or how would they execute on or encourage a drop and swap? Should that be the right thing for them to do at that time? And then what's their next move?
So it kind of gets into what I was saying earlier, where a 1031 exchange doesn't work with real estate into LLC ownership interest. A drop and swap is the same issue in reverse, where you have an LLC ownership interest in real estate, and you want to effectively do a 1031 exchange with your share of that ownership. What that drop and swap achieves is effectively translating or converting that LLC ownership interest into ownership in real property. And then from there, you could sell your interest in that property to do the 1031 exchange. And historically, there hasn't been much guidance on what is and is not allowed with the drop and swap. A lot of attorneys over the last couple of years, a lot of attorneys and CPAs, the logic has been, if you want to do a drop and swap, or the reverse of a drop and swap, where you turn a uptick into an LLC, you want to hold it for 2 years. That was the conventional wisdom. You want to hold it for 2 years because you don't want the IRS to look through the transaction. But what this recent case in New York, they made the argument that you can do it on the same day. You don't have to have this holding period. Which, to be clear, it's a case for New York state tax. So it's not a federal case. It's not guidance that the IRS can use, but it uses the same fact pattern, which is encouraging for folks wanting to do a drop and swap.
And I don't know if anyone has time to read the tax codes, but the tax codes are ultra specific, except for 1031s and drop and swaps or like-kind exchanges or holding periods. They don't have dates or times. They just have the concept of a concept that you need to hold it for a period that's acceptable to somebody that we don't know who that somebody is. Everything else in the IRS code is specific to date and times except this gray box. I'm not sure if it was intentional, but it sounds like it was. So there's a significant amount of ambiguity around how long you have to hold the asset before you can even do a like-kind exchange, but there's no definition to it in any tax code that tells you what the answer is, which is puzzling.
That's what I like to say. That's just Congress making it someone else's problem to figure out what they meant by that.
Someone to argue.
Yeah.
We have a question. Yes, sir.
So how can I do a lazy 1031 with this?
So, assuming that you are not a real estate professional.
Correct.
So you have rental properties that you own, right? And you sell those. There's a capital gain, and that capital gain is passive because you are not a real estate professional. So let's just say, for the sake of argument, you sell these properties and you have $500,000 of gain that you need to offset. Because you're not a real estate professional, all of your real estate holdings, both direct and indirect, are considered passive. So what that means is you would need to make an investment in an F Street deal that would generate $500,000 of depreciation losses in year one. Now, kind of getting into that cost seg, only a certain portion of the property is bonus eligible. So what that would look like on paper is contributing more than $500,000 to offset that full gain. But the idea is that you want to contribute enough to where those year one losses can offset that passive gain. So it's achieving the same thing without having to jump through the 1031 exchange hoops that you would traditionally have to jump through. Does that answer your question?
Yeah, but I thought last night we said that wouldn't work. I'll catch you.
Yeah. No, let's catch up later.
And the other part of it is whatever portion of it you do catch. So let's just say you make a $1 million investment and you get $300,000 of losses. You're taxable. Are you only then taxed on the $200,000? If you don't catch the full 500?
Yeah. So it's in a perfect world, we would be able to offset that full gain. Unfortunately, we don't live in a perfect world. It's going to be very hard to achieve that. But whatever you don't offset, you would
pay the tax on.
Yeah, and $100,000 capital gain versus 500, I'd take that any day.
Yeah,
so.
sure, absolutely. Okay, good. Yes, Patty?
Is there any differentiation between the asset being held in a corporation versus an LLC with regard to the 1031?
So to clarify your question, you're saying there's an asset held in a corporation and you want to do a 1031 exchange.
Correct.
So in that scenario, you would have to do the 1031 exchange inside the corporation. The assets themselves cannot leave the corporation. Otherwise, pulling out. When you say a corporation, do you mean like a C corporation or an S corporation? S. Yeah. So the issue with having real estate in an S corporation is that it needs to stay in there because when you pull it out, that's a taxable transaction. So you would effectively be selling the asset to yourself, which creates this large capital gain. So if you want to execute a 1031 exchange via an S corp, it makes the most sense to keep the assets within the S corp, unless you want to get them out. In which case, I would recommend talking to your CPA, your tax advisor, and kind of weighing the options there. But that's how that would work.
Yes, sir.
Could a perhaps lazy 1031 then be I have the same 500,000 in gain, call Scott and say, hey, what are you buying soon? I have this to put in, let's do a tick. And you're still on ownership and you've successfully defended all of your 1031 benefits?
Yeah, so we do that. We do that. That practice happens more frequently than a lazy 1031 for us. So what we see happen more regularly is a family or a person will be planning for a disposition. They are at the point where they do not want to continue to manage real estate, whether it's due to retirement or travel or pure entertainment, whatever the concept is. They want out of the boots on the ground doing the work, but they want their asset to be in something. And so we'll take an asset, they'll sell it, we'll take them and put them on the actual tick as their LLC owns X percentage, and F Street Sequence LLC will own the other portion of it, where we'll either syndicate that out or we'll complete that ourselves. So that happens quite frequently. We've done 4 of those this year, 5 of those this year already. Yep. Yes.
Regarding the F Street 92 offering, are there advantages to set up the entity as an individual or an LLC or some other entity identification?
So your question is, I don't think it's a taxation question. I think it's a protective question. So the school of thought has always been, this is going back to day one, buy every property, put it in an LLC, don't put multiple properties in there, liability's crazy, and I don't know. I've followed that practice for about 1 minute, and then I've deviated. When I was buying multiple single-family homes, let's say, for example, I put 80 of them in one LLC. Because if you had 80 tax returns with 80 different deals, you end up just creating a nightmare, and the liability risk never really exists, right? I have general liability on each property of $1 to $2 million of coverage. If, God forbid, something happened, usually it fills in that void of coverage under the general liability policy, which candidly has never happened in the 15 years I own 150 single family homes. So that never really happened. For an individual, I think the question, and I'd like to maybe rephrase it for Matt, is there any taxable benefits if an investor who's an individual or a family were to create an LLC to make the investment versus holding it in their personal name or their family's name?
From a tax perspective, it really makes no difference. So there's 2 scenarios. One where you create an LLC and you were the sole owner of that LLC, in which case the IRS would completely disregard it and you would just report the activity on your own 1040. When you actually get the K1, excuse me, there's actually a line item for listing a disregarded entity. So your name would still be on the K1, it would just have the LLC name on there. Scenario 2 is, let's say it's a family LLC and you and multiple people in your family are owners in that LLC, in which case that's fine, but that LLC would have a tax filing requirement. So it would just increase your compliance burden because every year you would have to file a tax return for that LLC as well. But from a tax perspective, it makes no difference because ultimately the activity is still flowing to you personally. So how you structure it, like Scott said, it's really more of a legal question. From a tax perspective, it makes no difference.
Good question. Yes, Ron.
Probably a stupid question, but is there a way to modify the debt fund in a way where the income goes from a 1099 to a K1 so it becomes passive?
Yeah, we tried this. We've tried 100 different iterations of this, and believe it or not, the government likes getting paid, so they've really made it restrictive. What we do see a lot of transition, which we'll hear a little bit this afternoon, is really from the deferment through self-directed IRAs or self-directed 401ks, where people are placing those dollars with us immediately and those dollars are deferred under those laws. The issue comes down to there is no other means to determine it other than income interest back to the investor. We've looked at distribution income and it still ultimately flows back to the investor. So we've exhausted a lot of different scenarios. It's very hard to circumvent paying the government, who they say is the toughest collection agency in the world, and that's probably true. And they have these certain laws where I think a bulk of their income comes from that they really spend a lot of time chasing. And so it's a tough environment. All right. Is there any other tax questions? I know tax sometimes gets a little bit granular and sometimes over people's head, but it's a big deal for everybody, and it's a big part of our ecosystem. So if there are any other questions, now is a great time. Otherwise, Matt's available and will be with us all evening. Yes, sir.
Like normal upfront depreciation, like bonus depreciation on buying into one of your development opportunities, what do you think that percentage is of that investment when you're looking at it for a lazy 1031 exchange, whether you can hit that pretty low?
Yeah, I use, it's an interesting question. I use the threshold of like 30 to 40% is generally what we see as a number that comes forward immediately. There's some peaks and there's some valleys to that number, but if you look at, a $2 million total investment, we can get back, we syndicate, call it 30% of it, and you get back about 15 to 20% in bonus value, and then you can kind of run the math, but that's what we kind of are anticipating in year one. All right, Matt, I appreciate you abruptly joining me here. What's the schedule now?